Good afternoon. Hopefully you can hear me. Hopefully I can hear myself. Um, I very much appreciate the ability to be here and to talk about this topic. It's a topic that's very important as we think about how to manage United Rentals. Capital allocation, in our view, is vital to any rental company, but in particular, if you're a large-scale rental company that is publicly listed, it's something that the management team should wrestle with on a daily basis. It's vital to the investors, it's vital to our long-term health as a company, and so I'm very pleased to have a chance to talk about how we think about capital allocation at United Rentals. Many of you know United Rentals, but real briefly, we are the largest rental equipment provider in the United States and indeed in the world. Number one market share in the U.S. at about 12%, so significantly ahead of the next largest player, who is Sunbelt, at about 7% in the U.S. market. At this point, our company is about 1,000 locations, a little over 1,000 locations across the United States and Canada. Those 1,000 locations include locations that we've added recently through the acquisitions of NES and of NEF, the NEF acquisition, which we just closed a few weeks ago. So 1,000 locations, about 15,000 employees now, and we serve from those locations a wide variety of customers and project types. You can see a view of it here, and I'll spend a little bit more time on our customer mix a little bit later on a later slide. Our fleet, just to give you a more up-to-date number here, Murray, our fleet now is about $11.6 billion. That includes the impact of the NES and the NEF acquisitions, and currently has around 500,000 units in the fleet overall. You can see the allocation of fleet here in the pie chart to the left. We are still very heavily an aerial work platform fleet at about 37% of our overall investment. That's down from where it had been in years past in the low 40s, and that reflects some of the fleet mix impact from the acquisitions that we've done recently. Reach forklifts are also a very important product in the U.S. and Canada. It's about 18% of our fleet of the total. You see that segment of earth moving or dirt equipment now at 14%. That's an important change for us as a company. The NEF acquisition brought along a lot of earth-moving equipment, and we believe brought along a lot of earth-moving expertise to help move us in the direction of serving customers who have more of an orientation toward infrastructure-type products. That was a key strategic element of us buying NEF, and I think it shows here in the fleet orientation of our company, and as we go forward, we hope to be able to grow dirt applications in our fleet as well. So those are some of the key points about United Rentals. Let me talk a little bit about this notion of capital allocation. In the past, equipment rental companies have been very focused on growth and very focused on profitability. And those things are vitally important for an equipment rental company. What equipment rental companies haven't devoted enough time and effort and focus to in the past, though, is the notion of return on investment. That's a very, very key piece of how investors evaluate an equipment company investment. We spent, over the time that I've been at United Rentals, a lot of time and effort struggling with the question of how much emphasis should we place on growth versus how much emphasis should we place on delivering attractive returns to our customer, or to our investor, I should say. And we think about it as a balance. And it's an everyday struggle to find the right balance between growth and returns. What I'll talk about in the next few slides is just a little bit of insight into how we try to strike that balance on an ongoing basis. But if there's a key message that I would deliver to all of you here today, it is you need to think actively about the role that returns play in your business and how to balance the desire for growth against your requirement, and it indeed is a requirement, your requirement to deliver returns over the long term. So here's how we think about it at United Rentals. And I'm trying to do it at a very high level, conceptual way, and not at the level of detail that we actually do during the course of a day. And apologies for those of you who don't think like an engineer, but this is my engineering background coming out a little bit in this process flow diagram. We start off to the left with the first question that we ask being, do we have the right amount of leverage in our capital structure? We start there because leverage for an equipment rental company is vitally important. You heard Kevin talk about it earlier today. Many rental companies have gotten themselves into real trouble by not being aware of the fact that their business is highly levered. Not only is demand deeply cyclical, but because of our high fixed cost structure, when that demand falls off, profitability and cash flow fall off even more dramatically. If you're not positioned to be able to absorb that, then you're going to have a problem. And so we think first and foremost about making sure that we've set the leverage of our company the right way. That means using our cash flow to set the right amount of debt. Debt relative to cash flow is how we manage leverage, or how we measure leverage. In particular, it's net debt as a ratio to EBITDA. Net debt to EBITDA is our metric. And we try to set that metric between 2.5 times and 3.5 times, depending on where we are in the cycle. There are a lot of other considerations, but really that's the main one, and it's, again, the first step in this cascade of choices that we make about how to allocate capital. So our first question is, do we have the leverage level set right? If the answer is no, then it's clear what we need to do in allocating capital. Any capital that we generate, either through profitability or new capital invested in the business, needs to go to pay down debt so that we can get the leverage down to where we believe it should be. If leverage is at a level that we feel comfortable with, then we can go to the next question, which is around organic growth. Organic growth in the form of capital investment, buying new fleet, is the lifeblood of our company on a day-to-day basis. So once we've assured leverage, that is the next place to focus and say, how much investment do we want to make to grow our business organically? And there are a lot of considerations around that question, one of which is where are we in the cycle? Where do we think we are in the cycle? And how will the cycle play out going forward? What are the customers that we're trying to serve with that organic growth? What are the product areas that we think warrant additional growth in organic capital? Those are the questions that we wrestle with to try and set the amount of organic growth that we're going to have as a company in the near term. And that sets the CapEx budget that we then manage to during the course of a given quarter or year. So after leverage, we ask the organic growth question, and that sets the amount of CapEx that we put into the business. Once we've made that decision, we don't move on to the next capital allocation question until we go back and ask, do we still have the right amount of leverage? Right? We keep going back to that leverage question again and again. So we set an amount of organic CapEx for the business, and then we say, after that CapEx, do we still have the right amount of leverage? If the answer is no, then you got to go back and you got to readjust your thinking about the amount of CapEx. If the answer is yes, then you can go to the third question. And that third question revolves around acquisitions. Acquisitions are a vital part of how we've grown United Rentals and how we support our strategy in the marketplace. So we're always looking for acquisitions that help enhance our strategy. So that next question for us is, do we have acquisitions that are likely to happen in the near term, and are we positioned to be able to execute those acquisitions? Can we execute the acquisition and still have a manageable level of leverage? There's that leverage question again. We go back and we say, after an acquisition, will we have the right level of leverage? If the answer is no, then we need to build what we call dry powder in the capital structure to allow us to be able to do that acquisition and still have the right level of leverage. If the answer is yes, then we get to the last question that we ask around capital allocation, which is, should we return some of our capital to our shareholders? That's the last decision that we make around the capital that's invested or being generated by the business. And in the case of the last number of years, the answer has been yes. So we've been able to assure our leverage, assure the amount of capital to grow the business, do the acquisitions that we have been able to do, and still have cash flow left over. We've returned a portion of that to shareholders. So at a high level, that's the process that we go through, and it's an iterative process that we go through again and again and again. Really, we reevaluate it on a continual basis, and there are a lot of details underneath, but that's the process. So I thought I'd start with a high-level look at the process. Next, I'd like to dive into each of those questions in a little bit more detail. And I'll take the first two together. The question about what's the right level of leverage, and the question about what's the right amount of CapEx that we should be investing. Both of those questions are heavily influenced by where we are in the cycle, or where we believe we are in the cycle. The challenge with this is that no one really knows where the cycle is, right? If we all knew where we were in the cycle, we'd all make $1 trillion trading on the markets, and we'd be on a beach somewhere, sipping Mai Tais. So that's the difficult part of this, is not knowing exactly where you are in the cycle. But you can make some broad assumptions about generally where you are in the cycle. Are you near a trough? Are you in the middle of the cycle? Or are you at what looks and feels like a peak of the cycle? Those are the questions that we wrestle with, and we try to position ourselves for CapEx and leverage against those broad questions. Regarding leverage, the way we think about it, I told you about that 2.5 to 3.5 times ratio that we manage within. The way we think about that leverage level is that we want it to be at its highest level during the trough of the cycle, and we want it to be at its lowest level at the peak of the cycle. The notion is that at the trough of the cycle, your cash flow, your EBITDA, is low. The business has fallen off already, and so the denominator of that leverage ratio is going to be small, and your debt level will be what it'll be, but as the numerator of that ratio, it'll be fixed or slightly higher. So that combination will push your leverage ratio up. What we want to do is to limit how high that leverage ratio goes to about 3.5 times at the trough. Conversely, at the peak, you're generating significant amounts of EBITDA, and you've been able, if you're managing things properly throughout the cycle, you've been able to actually pay down your debt balance. And so that leverage ratio will be low during the peak of the cycle. We try to limit that to about 2.5 times net debt to EBITDA. So that's how we think about managing leverage throughout the cycle, and we take action to try and maintain within that range. We're not religious about it, and so if we have an opportunity that requires us, say for an example, an acquisition, to go higher than 3.5 times, we'll do that. Conversely, if things are really going strong at the peak and we go a little bit below 2.5, then we're not going to get too upset about that. But broadly, that's the range that we're talking about. On the CapEx front, it's different. So the notion with CapEx is pull back when times are soft, when the trough is at hand. You want to minimize the amount of investment you're making in the company, because the utilization of that investment is going to be pretty low. But as the cycle starts to build a momentum, in the mid part of the cycle, that's where you want to be investing in growing your business, because your utilizations will be trending higher, your rates will be trending higher, and that additional investment will be able to generate attractive returns as the cycle continues to improve. But you don't want to go too far, and that's the art of this, is you always want to be mindful of not going too far and over-investing in capital as the cycle matures. And again, that's been one of the challenges in our industry in the past, is as things get better and better, everybody in the industry decides that they want to invest to grow their fleet aggressively. And then the peak comes and everybody's overfleeted and they're all chasing whatever business is there, and it tends to crash the pricing cycle. So we want to try and get ahead of that process and invest in CapEx to grow our business earlier in the cycle, and then restrain the amount of CapEx that we put into the business as we get later in the cycle. And that's been a pretty helpful model for us to think about. The specifics of the exact amounts that you invest and when you invest, well, that's a push and take, push and shove inside the management team, right? We're always debating this, and we're always trying to find the right answer. There is no clear guidance, but the best thing that you can do is continually ask yourself, do I have it right? And if you do that, I think you give yourself the best chance of actually getting it right. Regards the cycle in North America, I put this information here just to show you the market over the last number of years. This is data from the American Rental Association, looking at North American equipment rental revenues going back to 2007. So you can prominently see the, back to about 2003. You can prominently see the decline that we had from 2007 down to the trough in 2009. And you can see the trend of nice steady growth that we've been on over the time since. In fact, the last 4 bars here are the forecast from the American Rental Association, and they expect our current cycle to continue out through 2021 with something like 4% growth in our market consistently over the next several years. So some might argue that we're in an elongated, extended cycle right here and now, and that the peak should be coming any time now. Our view and the American Rental Association view is that we still have some time to go before we reach peak and start to decline. So those are some thoughts about the cycle and how it plays into the first 2 questions around capital allocation. The one thing I did want to do is to spend a little bit more time on this organic growth question, and not just talk about how much to invest in organic growth, but also some of the things that we do at United Rentals to decide exactly where those organic growth dollars are going to be invested. And we start here with a view about our markets and our customers. We think a lot about our markets. Which segments of the market do we serve? Which segments do we want to serve and grow in? And think a lot about our customers. Who are the customers that we think will give us the best opportunity to grow, but also to realize attractive returns? And this is some information that we put out for our investors, but it really just highlights the fact that we're thinking continually about how much non-res revenue should be within our overall revenue for the company. How much industrial? Is residential something we should be thinking about growing? Those kind of questions will really have an influence on how much capital you put into the business and where you actually allocate that capital. So will discussions and decisions about our customers. We are a company at United Rentals that's focused very much on large-scale, what we call key accounts. Large nationwide players or big regional players who really benefit from the scale of our fleet, the breadth of our fleet, the density of our branch footprint. Those customers are the heart and soul of our business, and they will determine how much capital and what specific allocation of that capital we make with the business. So asking ourselves, where are we going to grow with that customer base is a vital part of how we make decisions of where to put our capital. We also look at a product view of our business. We've been growing what we call our specialty rental businesses very aggressively over the last several years. And that growth is an important driver for exactly where we spend the capital that we decide to invest in the business. Specialty for us means trench safety products, power generation products, pump, tools products, and most recently, portable sanitation in a very small way in our company. So as we think about growing those businesses disproportionately, they're going to absorb a disproportionate amount of the capital that we decide to put in the business, and that helps guide our thinking about how to break down the organic investment that we make in our business. We also think, and maybe I'll just put up the whole slide here, we also think very actively about how are the levers of return being managed within our business. These are vital decisions around how much organic growth to put into the business and exactly where each dollar goes. So if you look to the left-hand side, if your goal is improving return, you can do that a couple of ways. You can improve the profitability of your business, the numerator of your return calculation, or you can be more efficient and reduce the amount of investment needed to generate that profitability. That's the denominator of the return calculation. And this is just a decomposition of those two drivers of return. On the profitability side, you have levers for improving your revenue or reducing your cost, right? This is pretty basic stuff we all understand. But having a rigid, structured way of thinking about it, we believe is important to making good decisions about where you're going to allocate the organic investment that you make in your business. In reducing the investment, looking at the assets that you have in your business, both rental and non-rental assets, and the working capital that you have in your business are vital pieces of how you can manage that investment more efficiently. And to the right-hand side, you can see all the levers that we have as managers to be able to influence those improvements. So if you want to increase revenue, for example, one way to do it is to increase what we call on-rent dollar utilization. It's financial utilization for units that are actually on rent. Well, that's about your rental rate, managing your rental rate. So let's have programs and initiatives focus on how you more effectively manage rental rates. Or it may be about the ancillary revenues that you generate with a rental, pickup and delivery charges. We have loss damage waivers effectively. We have other ancillary revenues that go along with the rental transaction that might improve your revenue. Same for costs, right? Looking at your labor costs, looking at the third-party spend with outside haulers, for example, or looking at your general and administrative costs or your selling costs and looking for ways to improve those. So this is a structure for thinking about what are the levers that we have as managers for improving the return that we get out of a dollar invested in organic capital of our business. We try to boil all this down in a structured measure. It's something that we call contribution margin. I don't want to go into a lot of detail about it, but it's a very useful way of thinking about what is the amount of profit and return that a given transaction will deliver to the company. We calculate contribution margin for every transaction at United Rentals, every one. And this slide shows you the components of that calculation. We start with the rental revenue that we get from that transaction, and we take away the key variable costs associated with it. Our delivery costs, repair and maintenance, commissions, other transaction costs, which really are allocations of things like our inside sales presence or other direct transactional business. But the important point here is that we also deduct the cost of capital for that transaction. So if you rent a piece of equipment, we actually calculate a component of that equipment's cost of capital, and we allocate it to this contribution margin calculation. That's a very, very important piece of this whole discussion because very often the cost of capital is forgotten. But when you go to this extent and you force each transaction to bear a portion of the cost of capital for the equipment that supported that transaction, then it gives you a very clear financial measure of the contribution that that transaction is making to your profit and your return after the cost of capital. That's sort of an esoteric concept. It's one that you don't hear a lot of rental companies talk about, but for us, it's an important part of making better decisions about where our organic investment in capital goes. The way we use contribution margin is, well, we use it in a number of ways, but this is just one example of how we could use it, right? If you go through and you calculate contribution margin for every transaction, then that gives you the ability to roll up those transactions in a number of ways. So here we show a customer view of contribution margin. So we go to each customer and we take every transaction that they've done with us and the contribution margin that they've generated with us, and we're able then to line up our customers in order of the customers that contributed the most positive contribution margin to our company. And that's what you see here. So from left to right, each bar represents a customer, and the height of the bar represents the cumulative contribution margin for every customer to the left of that point on the x-axis. What this shows you is that there are some customers who do very high contribution margin transactions with us. Those customers show up on the left-hand side, and we label them premium customers because they are very important ones to us. We want to make sure that we're serving them as actively as we can because they do deliver the highest contribution margin, the highest profitability, and highest return that we get. The customers in the next group of customers we've labeled attractive because while they're not quite as impactful as the one on the far left, they are still very attractive customers for us. There's a whole broad middle of customers that don't contribute quite as much. We call them marginal is sort of an offensive notion, but they really are marginal in the sense that they're not adding a lot to the contribution margin that we aggregate as a company. And then off to the far right, there are customers who are more challenging because each one of them has a negative contribution margin. They drag down the cumulative total. And so they're challenging because we have to think very actively about how much business we want to do with those customers and under what terms. But a measure like this can help really clarify how you think about where your capital investment goes across your entire customer base. And I just wanted to show an example of one of the ways that we use this measure of contribution margin. Let me address the last two questions that we ask in capital allocation. M&A is one that is an ongoing question for us. What you see here is the way we like to talk about acquisition opportunities at our company. We talk about three things that we look at when we consider acquisitions. One is the strategic fit. Two is the financial attractiveness of that acquisition. And the third is the cultural alignment of the acquired company relative to United Rentals. And just a couple of points on each. The strategic fit is vital in any acquisition. We don't look at acquisitions as being acquisitions just for the sake of growth. Growth by itself is not very useful for us. It's growth with attractive returns. But the strategic fit of an acquisition may incentivize to go and do it. That fit might be an acquisition brings along an enhancement to a set of customers that we want to pursue. They may bring a product strategy that really fits well with what we're doing. An example there would be the Neff acquisition, as I mentioned before. They brought along a very good mix of products in the earth-moving classes, but also customers who value those equipment and knowledge about how to generate attractive profits and returns in those classes of equipment. So that could be a motivator for us strategically. Or we may want to enhance our market position in terms of the density of our footprint in a market. In North America, we are now everywhere that we could be, that's reasonable, but there may be opportunities to build a denser network in key markets and help improve our efficiency. Or there may be operational benefits that enhance our strategy as well. So we go through questions like that around the strategic fit of an acquisition in a very detailed way to decide whether an acquisition is one that makes sense for us. On financial attractiveness, well, this is near and dear to my heart as a CFO, but these are the good old-fashioned measures that everybody's familiar with, right? What does it do for growth? What does it do for profitability, for margin? What does it do for return, your ROIC, your discounted cash flow analysis? We go through all of those financial measures to make sure that any acquisition that we do is attractive from that perspective. One that doesn't get thought about or talked about a lot when companies think about acquisitions, though, is this notion of cultural alignment. For us, having a company that we acquire be one that culturally will fit within United Rentals is very important. It helps us with the integration effort, and it also helps us avoid being distracted with businesses that may do things very differently than United Rentals does. And we've actually passed on acquisitions because we couldn't get comfortable with how a target company does business, right? We couldn't get comfortable that they were doing things in a way that we felt were appropriately ethical, for example. And that's something that very often companies overlook as they think about acquisitions. So as we go through these choices around acquisitions, we actually end up in a place that allows us to say, you know what, if we choose to do a given acquisition, we know it's going to be the right one for United Rentals. This year we've had a lot of success with acquisitions. I've mentioned NEF, I've mentioned the NES acquisition, and we've also closed on a couple of other smaller ones in our power generation business and in our portable sanitation business. And we owe it to not only a diligence about looking for acquisitions, but also a diligence about applying these concepts. So I think that's a very important thought when we ask the question, do we have M&A targets that make sense to invest in as a company? One last word about share repurchase. As I said before, it's the last question that we ask about should we allocate capital to that purpose. And again, over the last few years, we've chosen to do so in a fairly robust way. Right now, for example, we have a $1 billion share repurchase authorization that we are working against, and there's about $370 million left on that repurchase authorization that we've received from the board of directors. If you go back over the last several years, we've completed a $750 billion program. We've completed a $500 million program, and we've done some other repurchases in years past that. So this is something that we believe is a useful tool for managing where our capital goes, and we'll continue to execute on it as we go forward. Maybe I'll stop there and certainly would be glad to address any questions, but I will say again that this whole notion of capital allocation has been one that's vital for how United Rentals has managed itself as a company over the last, let's say, 10 years, certainly the 9 years that I've been at the company. And I think it's been an important part of how we've grown our company. We've grown our top line, we've grown our profitability as measured by adjusted EBITDA, and most importantly for our shareholders, we've grown our share price quite robustly over the time that I've been around. We're very proud of this, and we're proud of the fact that we still see opportunities to continue to drive United Rentals forward. And so you'll continue to hear about us thinking very concretely about capital allocation in the years to come. Thank you.
Thank you, Bill. Thank you. Is this working? Thank you, Bill. That was fantastic.
Thank you.
Do we have any questions from the floor? Question at the back. A microphone is coming to you, so Norty, just wait.
Hello, William. Okay, I guess it's my turn, or? Go first. Okay. Okay, William, thank you very much for your presentation. Really very interesting. One of your slides was about the looking at your customer portfolio and the contribution of each customer, which was quite an interesting analysis. So my question to you regarding to that one, because I saw that 50% of your customers is mainly marginal or challenging side. So how often do you bring that kind of analysis to your management team? And if you could share some practical examples of actions that you take based on that analysis. And the bonus question is, are you considering any M&A in China?
I was waiting for that second question. To the first question, we really discuss every month in our monthly operating reviews our customer mix and how it's progressing. Are we getting at the customer segments that we think are important? What are the initiatives that we have focused on those customers? And what progress we're making. So we're a very metrics-driven company, and we look at those metrics on a monthly basis to make sure that we're keeping on track to find those customers, to serve them effectively, to make sure our business is oriented toward delivering the value that they see and they expect from United Rentals. Regarding acquisitions in China, we don't have any concrete plan to acquire in China as we speak. But we have been, over the last several years, doing a lot of work in looking at various markets around the world, not just China, and preparing ourselves for the day where it might make sense for us to make an acquisition, whether in China or in other markets around the world. We'll continue to do that. We recognize that as a North American company, there are ways of doing business around the world that are not familiar to us. And come the day that we do make an investment offshore, we want to make sure that we're as smart as we can be about how to succeed in that market so that we give ourselves the best chance to succeed in that market. So stay tuned. We like to say that we're not offshore from North America today, but it's not a question of if, it's a question of when. But when we do decide, we want to be as smart as we can be.
Thanks for that question. Norty, I'll come to you in a second. So, talking about acquisitions, you've got a market share of 12% in North America, which is a leading market share, but in terms of a mature industry, it's relatively modest, isn't it? In terms of a fully mature, consolidated market. So that would imply that you had a lot of room for growth still in North America.
It does. We believe that there's still opportunity to build that market share significantly. And whether we do it through organic growth or acquisition will depend on the opportunities that we have. But we continue to look at opportunities to acquire in the U.S. We continue to look at opportunities to usefully invest in organic growth. And we think we've got plenty of runway to be able to grow that share robustly over the next several years.
Norty.
Hi, Bill. Well done.
Thank you.
As expected. You said that you and Ken at ARA, et cetera, feel that how the market in North America is going to continue to roll out. It's going to continue to extend this run up. Mm-hmm. My question is why you feel that way. So, and this is a two-part question. Second part is what keeps you up at night?
Yeah, certainly. Well, what keeps me up at night lately is traveling here from the U.S. But seriously, that's a question that we spend a lot of time thinking about. And the only thing that keeps me up late at night are the things that I can't control. So your first question about where is the cycle and what causes us to believe that it's got more room to run to the upside is about the only thing that really keeps me up at night. Because we're always asking ourselves, do we have the right view, right? Do we really understand what's going on with the cycle? And right now our view is that the level of construction activity in North America, while it has improved from the trough that we saw back in 2009, is still not unusually high. We've got one measure that we look at that kind of demonstrates this. If you look at the amount of non-res construction in the U.S., and plotted over the last 20 years on a per capita basis, so the amount of construction per person in the US population, that curve right now sits still right at about, you know, a little bit above where it troughed back in the bottom of the cycle. That gives us a very good sense that there is a lot more construction activity that could happen in the US before we start feeling like it's becoming excessive. So that's just one measure, but it is a measure that helps us get comfortable that the cycle is not being extended right here and now. Now, it's not ultra precise. It can't tell you, oh, the cycle is going to end in October of 2019, for example, but it certainly can give you a broad sense of whether construction is overextended in the economy. But we look at a lot of other measures that give us a level of comfort. Most importantly, we look at what our customers are telling us and what they're doing. So we survey our customers every month and ask them really the following question. What is your expectation for your business over the next 12 months? Is it going higher? Is it going to be flat? Or is it going lower? And as you track that response on a monthly basis, you start to build a sense that the customers, looking at the projects that they look at, are pretty comfortable for the next 12 months or so. Now that's the way the question is phrased, so you know we can't extrapolate much beyond 12 months. But certainly in looking at their responses, we get a sense that the market, the demand for construction activity is still pretty robust in the US and actually is improving in Canada. And so that's another example of the kind of thing that makes us comfortable that we've got room to run. I don't know if I'd be as bold as the American Rental Association and put a number on 2021. That's probably a little too far in the future for my taste. But if you ask me about next year, I say next year is going to be a good year. If you ask me about 2019, I'd say 2019 is probably still going to be a growth year. Much beyond that, we'll have to wait and see. But you know what? Give me 2 years. I feel pretty good about where we are in the cycle. So hopefully that helps, Nordy.
Thanks, Bill. One final question, Thomas Lau.
Hi, William. My name is Thomas Lau from AP Rentals Hong Kong. Very impressive presentation. Regarding the organic growth, you mentioned the topic increasing the specialty of exposure. And then general rental, you mentioned about 81%. The 90% are specialties. Can you describe more detail on the specialty? What is that? Would you mind to tell me more?
Certainly. So as I mentioned, specialty for us means trench safety products, pumps, power generation and HVAC equipment, industrial tools, and most recently, portable sanitation. So those are the product categories. And why we call them specialty is that they typically involve services beyond just providing the equipment. So for example, if you're renting a large-scale generator to someone who needs power generation capability, very often they need engineering support to figure out exactly how big a unit. They need engineering support to figure out the cable runs that they need. They may need load centers to help balance the load as they bring up and bring down different sources of load from the generator. That engineering component of the rental transaction makes it, it's more insulated from just a pure brass knuckle pricing competition between us and the competitors. And you could say the same thing about the pumps business, right? How much head do you need? What are the runs of piping that's needed? Same thing with tools, industrial tools. So it's that extra service component along with the rental of equipment that makes it special for us. And in our experience, that means more attractive returns, better margins, and in most of those cases, better growth. And that's been a very attractive set of investments for us.
Very good. Thank you very much.
Thank you.